Okay, hello and assalamu alaikum everyone. I am Kashif Kamran. Welcome to an important session where I will be investigating, or rather, I will be having a quick scan of the challenges inside the AAA March-June 24 exam paper. Let's open up the session and let's ensure we have a quick scan because the session is being held on Sunday when your exams is on Monday, that is tomorrow. Now, in terms of the assignments I have checked for students for the paper March, June 24, and probably I've received 100 plus assignments of March, June 24 paper, and students sent me the question number one, two, three, and I went over them. So I thought this is the conclusion, which I would like to share with you all. In the question number one, which is a 50 marks question from the March, June 24 paper, there was a question number one, part B and C, which I found very challenging in terms of the way the answers were written. Some students wrote really good answers, and some students know the techniques to impress the marker. And I'll be sharing some answers with you just to guide you what best you can do when you get something challenging. There was a question number one, part B, right on your screen, which says justify why each of the following issues have been identified as a significant risk of material misstatement. And three issues are operating license, operating segments, and oil and gas extraction platform. You will need to determine and apply an appropriate level of materiality threshold in your briefing note. Now, you're very familiar with this, that in any audit risk question you get, or in any risk of material misstatement question you get, the partner email contain a materiality threshold, and you have to use that for the determination of that materiality. And you're very familiar with the marks for this, right? You're very familiar how much marks will you get from 14 over here, right? You have 14 marks. So that means in terms of the 14 marks, you will be getting 3 easy marks here for determination of the materiality. So eventually, you will be left with 11 marks to apply on operating license, operating segments, and oil and gas extraction platform. Now, this is nothing unusual if you have practiced the recent 5 exam settings or you have practiced the recent 6 exam settings, which I have told you. You must have seen this question a couple of times. Examining team asking you justify, even in the mock exam, right? Justify why the part inventory or the used car inventory is a significant risk of material misstatement, or in previous papers asking you justify why goodwill is a significant risk of material misstatement. So you do get questions like such, where the examining team asks you in the part A that uh, I ex evaluate and prioritize the significant ROM, or evaluate and prioritize the significant audit risk. And then in the second part, the examining team asked you justify why this particular ROM is a significant risk. Now, in this question, they've asked you three, and the whole question is around that. In the first part of this question, it was the business risk. And business risk answers, which I've seen for students, were very good into that. So I'm not spending any time on that. But the ROM answer, which is in front of your screen for 14 marks, needs some discussion. I hope you're all familiar with this style of question in the recent papers, where the examining team tells you that justify why a certain ROM is a significant ROM. You must have seen this a couple of times in the recent 5 papers, right? I hope you're familiar with this style, right? Okay, good. Then in the second part, it was design the principal audit procedures to be performed on the impairment of the cash generating units for the extraction of oil and gas. Now, if you have seen the paragraph of oil and gas in the paper, I'll just show you that. There was, I think, a lot of information about how they were determining the recoverable amount and how they were determining the impairment. around these cash generating units. So I think there was plenty of information to identify the facts and to convert those facts into procedures. You know my technique of making procedures, right? I always tell students that you have to use CASP, and C is the case. And you have to read the case, you need to identify the facts, and then you have to convert those facts into a proper answer. Now, I'll just be demonstrating that quickly without wasting further time. Now, when you look at a question like such, if I take you quickly to the practice platform, I hope you can see the practice platform in front of your screen now. And when we look at the question number 1 and we look at the partner email, in the partner email, uh, the other requirements were very typical. A requirement asking for business risk, B requirement asking for ROM, C asking for procedure, and D asking for some sort of auditor responsibilities from the Exhibit 5. We know this is a very typical style of a question that always, in a question number 1, there is something special in Exhibit 5. An examining team will also give you a D requirement in relation to the Exhibit 5 or in relation to the Exhibit 4, sorry. I think there is a mistake over here. It says Exhibit 5, but there are only 4 exhibits, right? So that means technically the last exhibit. Now, this is a mistake by the ACCA. It's not from my side, right? So you know this is a tendency of the examining team that they tell you that use the 4th exhibit for a D part requirement. And there is something special. Sometimes there are ethical and professional issues. Sometimes there are auditor responsibility for laws and regulations. Sometimes there could be something like outsourcing. And there's something specific going on every time in the D requirement of the question number 1. Am I correct in that? If you can please answer quickly. Have you seen papers where every time the question number 1D has a specific connection to the last exhibit? Right? And there is something special going on in the last exhibit, right? And you have to read that last exhibit to construct your answer for the D requirement. And that's the case here with the March-June 24 paper itself. Okay, now this part of the question, right, on your screen, justify why each of the following is a significant ROM, and we have 14 marks for that. I just Control C, and I take it on my briefing note area. I'm not constructing the briefing note. You're all very familiar with constructing the briefing note. So I'm not just filling it. I'll just say to, I'll just say from, I'll just say date, I'll just say subject. You know how to make it up. And then you know you have to write an introduction. And after the introduction, you will have the part A. And in the part A, you will have business risk. You have 10 marks for business risk, so you will be writing 5 business risk. Where that ends, you will have the B part, and in the B part, you have this requirement. Justify why each of the following is a significant ROM. And you have 3 ROMs to justify here. One is an operating license, one is an operating segment, and then one is a oil and gas extraction platform. So you have to do these 3 under the B part. So the B part is dealing with risk of material misstatements, and examining team is telling you that you have to determine and apply an appropriate threshold of materiality in your as given in your briefing note, and we have 14 marks. So first of all, under the heading of the risk of material misstatement, we'll write a paragraph for materiality, and you know how to write it down, right? Now, just let's check what's the partner email telling us. The partner emails tells us that you need to base your overall materiality on the profitability of the group. So you have to base it on the profitability of the group. And you know, on the basis of the profitability, it's 5 to 10%. So first you will calculate 5%, then you will calculate 10%, and you will get a mark for that. Secondly, you will tell that which materiality will you be choosing, 5% or 10%, and why? You have your own justifications. This is a recurring audit. We are not doing audit for the first time for Magenta Group. This is a recurring client. So you need to decide whether you will go for 5 or 10. Now, every student can have a justification. Some might say that even though it's a recurring audit, but we still have a lot of risk, like we have risk from operating license, operating segments, and oil and gas extraction platforms. It's given over here, right? You need not to go into the scenario. You know these are 3 specific risks given on the partner email. So considering the 3 specific risks, we should keep the materiality level at 5%. One student say no, because it's a recurring audit, and despite there are three major risks given, we will keep it at 7%. So you have to choose. But first you will calculate 5%, then you will calculate 10%, and then you will see whether to go for 5, whether to go for 10, or whether to go for 7. So you will go that way down, right? So if just to show you one way finally before your exam starts in, just sorry, 1 minute. I hope you can still see the practice platform on your screen, right? Now, in the materiality paragraph, uh, if I can show you one quick answer of the student on your screen, if you can see that. I hope you can see a student answer on your screen, right? He's giving an introduction. But just let me emphasize on that as well. This student has given an introduction, which is almost going on 1, 2, 3, 4, 5, 6 and a half lines. I prefer that you keep the introduction to 3 lines max. Save your time because introduction, you're saying the purpose of writing this briefing note is to evaluate the business risk. Uh, is to evaluate the business risk, comma, the significant risk of material misstatement relating to operating license, operating segments, and oil and gas extraction platforms, is to perform procedures on impairment and to do something in the part D. That's just like 3 sentences, right? I a lot of time I've seen students writing a very lengthy introduction. So I would prefer that when you're writing the introduction, keep it to 3 sentences or just like 3 lines maximum, because you just need to give that the purpose is to do A, B, C, D, and just concise that rather than dragging it. Okay, then the student has given the business risk. I'm not interested in that because that was more and less a good area of the students. But then he came down with the materiality part. I hope you can see somewhere down here. He will be starting on with the part related to B, right? See, now in the B part, he first told the materiality threshold for the audit is based on profit before tax as prescribed by the partner, which is in the range of 5 to 10%, which would be 161.65 million and 323 million, right? So at the very first go, he's telling the range that the range of profit is 5 to 10%. A lot of time the student picked the wrong range, which annoys the marking team. 5 to 10%. And on that basis, he calculated 161 and 323 at 5 and 10. Then he justified, considering the fact that Magenta is a listed group and has international operations, along with the fact that the market is focusing towards sustainable business, it would be appropriate to set the materiality threshold at 5%, which is 161.61. So look at the justification. He's saying that I am using 161.65, but is he telling why? Is he telling why? So that is important, right? So it's not just to tell the range, because when the moment you're telling this range, you're getting a 1 mark, but then you're telling that my level of materiality is 161.65, you're getting your 2nd mark. But then your justification, look at this justification, why he chose 5% in the red. That red is giving him the 3rd mark, right? That red is giving him the 3rd mark. So please ensure that you justify. Now, if a student says 7%, now on the above you have done 5 and 10, but you says that considering it's a listed group and has international operation, it would be appropriate to set the level of materiality. Suppose you says at 7%. So again, you have to calculate 7%, right? Because on top you've calculated 5 and 10. Then you will say at 7%, which is, and you calculate the $1 million again, because you have not shown this value above, right? You have shown 5 and 10% above. So you have to do one extra effort if you go in between 5 and 7. Now, my perception is it's a recurring audit, though it's a listed company, and there are a couple of risks given on the partner email. So if I would have gone, I would have gone by 7%. I would have gone by 6%. I'm not saying 5% is wrong. 5% is absolutely right because that's the justification. There is no one right and wrong answer for materiality. The marking team is just looking at your justification, and there is no one benchmark justification that only if you write this, you will get 3 marks. No, 5% tick right, 6% tick right, 7% tick right. They're all right. Probably we know we don't take 10% because that's too high materiality, and refrain from taking 10% in the exam paper. Ideally, for the first year audit, we take 5. Recurring audits, you could be 6 and 7 because even with recurring audits, we have risk given in. Is that clear to all of you? Then he went down. Then he went down writing about operating licenses. Then he went down writing about operating segments. Then he went down writing about the oil and gas extraction platform. Now you have to be very careful here. Just let me show you what carefulness I need from you to be demonstrated. Let's get back to the practice platform. Now, the moment you write the materiality para, you will be getting 3 marks. Now, how many marks are you left with? 11. And you have to write 3. Now, you know the approach, right? You know the approach how you write a risk of material misstatement answer? Anyone? You know the approach how you write the risk of material misstatement answer? You first comment on the materiality. You then comment on the treatment. You will first identify the issue in the management treatment, what is wrong in the management treatment. Then you will tell what is correct. And because of the wrong in the management treatment, you will tell what is under and what is overstated. So for example, you will first tell materiality, your comment on this. Then you will be telling what is wrong in the treatment, what is wrong in the treatment adopted by the management. You get 1 mark for this. Then you will tell what is the correct treatment. And then finally, you will be telling what is under or overstated because of management wrong treatment. Because of management wrong treatment. So ideally, these are 4 marks. If you write all these 4 in a typical ROM question, which says evaluate and prioritize the ROM, a typical one, right? Or evaluate and prioritize the audit risk. Then by writing all these 4, you get 3 marks because each audit risk or each ROM is maximum 3 marks, right? But when you get a question like such, justify why each of the following is a ROM, then for every justification, you get 1 mark. Materiality, 1. Wrong accounting treatment, 1. What is the correct treatment, 1. What is under and overstated, 1. Are you clear with this? Will you remember this cycle? Will you remember this approach? Right? So please follow this 4 lines approach. You have to follow this 4-line approach in every audit risk and ROM question. But yes, if you get a typical audit risk and ROM question which says evaluate and prioritize, you know that 18 marks question or 20 marks question, then you get 3 marks for this, right? But if you get a question like such in March 2024, where you have been given the risk, operating license, operating segment, oil and gas extraction platform, then for every justification, you're getting 1 mark each, right? So that's how you go down into it. Now, just a quick example. You go back to the meeting notes, and in the meeting notes, we have been given about operating license right here, and you read the operating license quickly. It tells us the group holds oil and gas extraction licenses for each platform. The range of duration is from 20 to 50 years. So they have a finite life, so they should be amortized. However, all licenses are amortized over a 40-year period. They have a life of 20 to 50, but the management is amortizing it on 40. Control C, where would I put it? Where would I put it? Under bullet number 1, under bullet number 2, under bullet number 3, under bullet number 4. Where would I copy paste that when I'm making my answer? Should it go under where? Is it the wrong accounting treatment adopted by the management? Under the bullet number 2, right? So in the exam, I'll be putting this under my bullet number 2, right here. So this is the wrong treatment, right? Why is management amortizing them on 40? Because the useful life is 20 to 50. Now, in this case, some will be understated, some will be overstated. In some cases, the intangibles will be overstated. In some cases, the intangibles will be understated. And so is with the amortization expense, because you're taking a 40 years average life, which is absolutely wrong. And then you write the correct treatment. And the correct treatment is that each of these license should be amortized on their respective useful life, 20 to 50, whatever that is. Then we have the materiality statement, right? Which is right here. How much is the amount? The carrying amount of the license is 7210 million. Control C, and you bring this right under materiality. This will help you when you're writing the answer. See, this is like a reading and planning time. And in the reading and planning time, I have just made my structure ready. And in my structure, I'm copy pasting what I'm getting. I got materiality. I got what is wrong. Now, what is correct? This is I have to write. This will never be given in the exam paper, right? This is this is something you have to write. This is something you have to write. This is where your SBR knowledge will come from. So this is pure knowledge. This is pure knowledge. And you can just write 1 to 2 sentences. Now, look at this accounting treatment. You will simply be telling that each of the license should be amortized on their respective useful life, full stop. That's one sentence. Yes, in an impairment related standard, you have to talk a little bit more that impairment is recognized when the carrying amount exceeds the recoverable amount. The recoverable amount is the higher of the value in use or the fair value less the cost to sell. And impairment is recognized when there is an indicator of impairment. So that's like 2 to 3 sentences. Now, how much standard treatment you write will vary from a standard to standard. But probably the maximum length of what is the correct treatment, max could be 3 sentences. No need to go beyond that. And then you write what is under and what is overstated. Right? So please, if you have any questions not related to March June 24 paper, please post them in the WhatsApp group. I will immediately be replying right after my class ends. Okay, then what is under and overstated? That's something you have to do. You have to judge, right? So again, this is something you have to judge. Now, how many things you will be getting from reading and planning time? You will be getting materiality from reading and planning time. You will be getting what is the wrong accounting treatment from the reading and planning time. What is the correct one? You have to write it on your own. And what is under and overstated? You will immediately think of that, right? So that's the structure. Now see how easier the life is. Now you simply go by commenting on this and see how lengthy it becomes. You will go from here and you will start writing. For example, you first tell just 1 minute, sorry. You first tell that the sorry, I just copy paste here. Control C, Control V. The carrying amount of the licenses is 7210 million, which exceeds the materiality threshold set above. Hence, it's material. I straight away get my 1 mark, full stop. Then I'll say copy Control C, Control V. The range, these licenses range in duration from 20 to 50 years. However, all licenses are amortized over a 20-year period, which is inappropriate or a wrong accounting treatment, as each of them is a wrong accounting treatment, as they can't be amortized on an average lifespan. Full stop. The each of the license, each of the license should be amortized on its respective useful life, full stop. Thus, at present, some of the thus at present, the intangible assets are either, because you're not sure, some are under, some are over, right? Because some are 20 years and you're amortizing them on 40 years, some are 50 years and you're amortizing them on 40 years. So thus at present, the intangible assets are either under or overstated, and the amortization expense and the profit is also under or overstated, full stop. And you're getting your 4 marks here, right? Completely. You talked about the wrong accounting treatment, you got 1 mark here. You talked about the correct accounting treatment, you got 1 mark here. You talked about the under and overstatement, you got 1 mark here. So that's 4 marks. If you write this much in a typical audit risk question or a typical ROM question, you get 3. Now, see, I just copy pasted information, right? Now, if I just quickly tell you another one, now I'm not going deeply into things, right? So at least we have read this much. Please, if you have any questions, just wait for 5 minutes. Just let me complete uh, the scenario, and then I'll speak with you. Okay, you go to the second one, the operating segments. We have operating segments in the meeting in the background information. You go to the background information and you get something about operating segments. It says right over here. Uh, in addition, sorry, right here, renewables, right? Renewables is a new segment. The group operates a new renewable energy division to reflect the growing demand for environmental sustainable energy. The division was created in response to the environmental concerns surrounding the risk of climatical resulting in greenhouse gases. The group long-term plans are to continue to develop renewable energy sources in order to meet the climatical change targets set by the government in the country in which the group is headquartered. In addition, this division act as a protection against fluctuation in oil and gas wholesale prices. The renewable sales are expected to reach the threshold to be reported as a separate segment of revenue for the first time for the year ended 30th September 2025. Now, is this the accounting treatment? Is this the accounting treatment, the last 3 lines? The renewable sales levels are expected to reach a threshold to be reported as a separate segment under IFRS 8 for the first time for the year ended 30th September 2025. And you know, Magenta is a listed company and IFRS 8 applies to a listed company, right? So this is basically the accounting treatment, right? Control C, and we just take it down here and we copy paste this under the operating segments. Now, under the operating segment, we know this is the accounting treatment, right? And we know the group is listed. Okay, then we go further in the meeting notes 3 and we find renewables given here. Can you see renewables given here as a breakup of forecasted revenue for 20x5? They were not reported last year because they have been classified as an operating segment for the first time in 20x5. They were not reported separately the last year. Okay, what's the revenue? 15,254. And what's the total revenue of the company? The total revenue of the company is 108 million right over here. Can anyone find me the percentage quickly? Can anyone find me the percentage of renewable in the total revenue? 15,254 divided by 108, 276 million. Can anyone do that quickly? Is it exact 14%? Okay. So renewables are 14% of the total sales, right? Okay. So we get another point. Renewables are 14% of the total sales in 20x5, hence meeting the definition hence meeting the definition of IFRS 8 operating segments as it exceeds the 10% threshold required by the standard, as it exceeds the 10% threshold required by the standard, full stop, right? Now, the only concern we have here is, if you read this very carefully, is that last year disclosures are not given. We have no corresponding value given for renewables. So it makes it very difficult to judge in absence of the corresponding figures. No corresponding figures given. No corresponding figures given. So difficult to judge, uh, difficult to judge or difficult to compare how much has been the increase or decrease. And plus, there is a risk of a management bias because they are doing this renewable energy sector in a growing pressure. There is a lot of growing pressure if you've read the scenario, and it was written that a lot of institutional investors are putting a pressure and they're preferring companies who are into sustainable fuels. So I think because of that growing pressure, and even the banks are putting the condition that banks will give you future loans only if you are into sustainable energy. So I think because of the pressure from institutional investor and banks, which is given somewhere in the opening paragraph of this case around Magenta, I think management might be doing some sort of window dressing here. What if the sales from renewable is not 14%? They have misclassified sales from the other segments to the renewable segment. Misclassified sales of other segments into renewable. Is that a logical, skeptical mindset? You have professional skill marks for skepticism. Is my skepticism right here that management could have misclassified sales of other segments into renewable to boost to boost the percentage to a reportable segment, to boost the percentage to a reportable segment, to impress the investors and bankers to get future loans, etc. So is there a risk of management bias when they are showing that this segment is giving us 14%? You will get extra professional marks here, right? Because you're adding the biasness of management here. You're adding the skeptical mindset here that what if they have misclassified some of the revenue from other segments to the renewable segment and shown renewable sector segment better? Are you getting are you clear with my perspective here? All of you? Right. So operating segment, this particular segment is how much? 15,524. So you can use this as materiality, 15,5 to 15,254. That's the total revenue from this segment. So the total revenue from renewable is the total revenue from renewable segment is $1 million. It's $1 million, which exceeds the materiality threshold, which exceeds the, you can even copy paste in the exam paper, right from here, which exceeds the materiality threshold, hence it's material. Control C, and you bring the same line down here rather than writing it again and again. You can use the Control C and Control V and save your time. So that gives me the first mark. Then I will speak of the management treatment, that the management is classifying the renewable as an operating segment, which by definition is right because it's 14%. But when you say by definition it's right, you're also speaking of the underlying risk of it being misclassified. The other segment sales are misclassified to show it better, or management is doing a management bias here just to impress the institutional investors and banks. So this is the risk, right? So it could be possible that particular renewable segment has not classified as an operating segment, and management is reporting it as an operating segment. Is that clear to all of you? So you will get marks in order. Yes, sure. Okay, in the same way, you go down to the oil and gas extraction platform. And in the oil and gas extraction platform, there were a couple of issues, probably the lengthiest one. If you got 4 marks from operating licenses, and on average, you got 4 marks, for example, from operating segments, you're just left with 3 marks. So if you go down to the background and meeting notes, sorry, and in the meeting notes, you have the oil and gas extraction platform, where we also need to make the procedures on impairment. So let's see what's the issue here. The group operates 38 offshore oil and gas platforms varying in sizes. These are classified as property, plant, and equipment with a total carrying amount of 29,201. The cost of the platform includes the estimated future decommissioning cost, discounted at the present value at the date the platform is ready to use. So they have included the present value of the decommissioning cost in as part of the platform cost, which is a good accounting treatment. And the total carrying amount of these these are classified as property, plant, and equipment with a carrying amount of 29,201, which itself is material. Control C, and you take it under the operating license. Number one. Number two, each oil platform is depreciated. Now, that's the first problem. Based on the amounts of the oil and gas extracted as a proportion of the total expected volume over the lifespan. Now, this is very good because this is how the economic benefit comes to the entity. And you can choose a method of depreciation which is based on the economic benefit flowing to the entity. Now, this is a wonderful method. We're not criticizing the method because it's based on the oil and gas extracted as a proportion of the total expected volume over the life of the oil platform. And on that basis, they depreciate these oil extraction platform. But yes, there is a lot of subjectivity because look at these words. Depreciated based on the amount of the oil and gas extracted as a proportion of the volume of the expected volume. Look at this word, expected volume. You have a lot of subjectivity in estimations, and anything which is estimated has a risk over the lifespan. Depreciation for the year ended is $926 million. So you bring about this whole paragraph here and you quickly say that yes, depreciation is material. Control C, you go down and you copy paste this paragraph here and you say, yes, number one, depreciation is material. Again, as it exceeds the threshold given above, which exceeds the threshold given above, Control C, Control V. You bring that first statement here. Then you say there is a lot of subjectivity. Sorry, the method to depreciate is correct, but has lots of subjectivity in the estimation of the total expected volumes. Total expected volume. The subjectivity increases risk of management bias in understating the depreciation expense and overstating the property, plant, and equipment. Now, wherever you get subjectivity, that subjectivity automatically goes in favor of management. The management is reluctant. Management always understate the expenses and overstate the profit. That's a window dressing model we take in the AAA paper. So the subjectivity increases the risk of management bias in depreciation expense in understating the depreciation expense and overstating the property, plant, and equipment. So that's what you're writing around here and scoring marks. Again, you're talking skeptically. You're talking about the management bias. So again, you're going down fetching your professional skill marks as well. So the treatment of depreciating is fine. That is an acceptable treatment because that's on the basis of the economic benefits. But there is a lot of estimation in that, which increases the subjectivity, and then that can be used in the favor of management to understate expenses and overstate the profit. Then you can go down further if you want to. No, I'm not calculating materiality on the whole part. I'm just calculating materiality on the issues, right? So I've not yet calculated materiality on 29201. I have calculated materiality on the issue, which is 926 million. Okay, then I'll go down further. There is another issue here, which is basically the issue around impairment. The group treat each platform as a CGU and perform annual impairment review. Wonderful. Where an indicator of an impairment exists, the group perform an impairment test. So that's wonderful, right? At least they're performing an impairment test and they're treating each platform as a separate CGU for that purpose. So far, so good. Due to the nature of the oil platform and difficulty obtaining a market value for the sale value for each side, the impairment test compares the carrying amount of the combined platform with the value in use. So they're not calculating the fair value because I think that's difficult to estimate, but they're only comparing the carrying amount with the value in use. Future revenues, look at the estimations. Future revenue estimates are estimated based on long-term oil and gas price predictions. Look at the word prediction. And the costs are based on average operating and capital cost associated with specific platforms after adjusting the predicted inflation rate, average cost, not the actual cost. These are then discounted at the standard group discount rate of 1.5%. What if the discount rate is different for these oil extraction platforms? What if this discount rate is wrong itself? So there's a lot of subjectivity in how the management determine the value in use. Look at the number of times we have gone the words future revenue, number one, estimate, number two, predictions, number three, average, number four, again, predicted inflation rate, five. So much subjectivity in value in use. And again, wherever we get subjectivity, it becomes an inherent risk. It becomes a risk of management bias because management can choose to show a lower impairment loss or a lower impairment recognition because that favors the management. Already they're doing a reversal of impairment, which might be a technique to window dress a financial statement. They're doing a reversal, which is quite a significant amount. It's above your materiality threshold. And even the losses recognized are 350 million, which is again material. So when you comment on the materiality, you will tell that 350 itself is material, which is the loss recognized, and the reversal itself is material. And reversal might be used as a technique to window dress a financial statement. And look at the subjectivity we have in value and use. And the subjectivity can be used in favor of the management to fabricate the financial statements. And again, you need to ask management about their underlying reasons why fair value cannot be obtained because you're purely relying on value in use. You're not relying on higher of value in use or the fair value less the cost to sell, which is the proper formula, right? So management is testing impairment. Wonderful. Is the management treatment right? Yes. But what is wrong in the management treatment? They're not determining the fair value. Number two, the value in use is very subjective. So because of that subjective value in use, there is a possibility that the impairment loss at $350 million is understated. It should be more than that. And secondly, the reversals is a very big amount, a significant amount of reversals. So is there any management bias behind reversals as well? So I think under oil and gas extraction platform, there is a depreciation issue and then there is an impairment issue. Under impairment, one is the $350 million issue, which relates with the estimations in value in use, could be under and overstated. And one is the reversal issue, which could be used as a technique to fabricate the financial statements. And if anyone knows the proper accounting treatment of reversal, that to what extent you have to limit the reversal, you can even write that down. Is everyone clear with this? So there was plenty to write in this answer. It's just about understanding. It's just about reading. But are you getting the way to put the materiality paragraph first, then giving three headings: operating license, operating segments, and oil and gas extraction platform, and how to get marks? uh, First of all, think about materiality, then think about what is wrong in the treatment, what is the right treatment, what is under and overstated. If the management treatment is right, just like impairment, still with the right treatment, look at the component, the recoverable amount. The recoverable amount, uh, there was a lot of subjectivity. So you have to speak of subjectivity. You have to speak of the inherent risk. You have to speak of the management bias. There was a lot of management bias in this Magenta group. It was a listed company. They had a lot of pressures from institutional investors. Probably that was the reason they were showing the renewable energy sector separately this time. So I think a lot of skepticism marks, a lot of judgment marks are coming your way when you write answers in such a manner. Is everyone clear? Should we move on to the next one? We have limited time for the session, so just need to brush over the other parts as well. Okay. Okay, then you have procedures. Uh, Something which is a difficult parameters for student, despite I have told them that you have to apply CASP. How many marks you have? 8 marks for procedures, right? 8 marks for procedures means 8 procedures. And you have to make procedures around what? You have to make procedures around impairment. Control C, take it to your word processor, and Control V. Let's see if you can make procedures around impairment of the cash generating unit. Okay, now first information. Has the management performed the impairment review? Yes or no? Has the management performed the impairment review? Look at the screen in front of you. Has they performed the impairment review? Yes. Look at the paragraph number 3. So first of all, whenever the management has performed an impairment review, can I think about making a procedure around uh, can I make a procedure around uh, the management working, the management impairment working? So I see how management has calculated the impairment loss. Can I see management impairment working for the impairment loss? Number one, you know how to make a procedure, right? I'm just giving you a thinking point. So management impairment working, impairment loss basis, uh, discuss why uh, determination of fair value or the sale value is not possible, or can there be any alternatives to assess it? Can there be any alternative? Because management is saying it is not possible. Can there be any alternatives to assess it? So you're asking this to management, discuss. Okay, then due to the nature of the oil platform and difficulties obtaining a market value for sales value, the impairment test compares the carrying amount of the combined components of the value in use. Future revenues are estimated based on long-term oil and gas price predictions. So future revenues are estimated based on long-term oil and gas predictions. Control C. So you can just have a review of management uh, basis or management underlying assumptions taken in determination of future revenues. So how management has determined the future revenues, what basis have they taken, and are they realistic? Are they realistic versus auditor knowledge of business? Auditor knowledge of business, something like that. Then you move further. Costs are based on average operating and capital costs. So costs are based on average operating and capital costs. So discussing with the management, why are they not taking the actual ones? Uh, Cost are based on this. So you discuss with management, discuss why not actual, something like that. So you're taking the facts from the case, associated with specific platforms after adjusting the predicted inflation rate. So you need to see if that has the management estimations of the predicted inflation rates. Review management predicted inflation rates for reasonableness. Are they reasonable um, as per auditor knowledge of business? Then you go down making procedures on they are discounted using a platform 1.5%. Uh, again, uh, assess the assess the reasonability of the discount rate used. You can recalculate. You can recalculate the impairment loss. And you can also take a representation letter from the management because there is so much subjectivity, a representation letter on the overall completeness or overall completeness of the value in use taken by the management. Because there's so much subjectivity, right? So that gives you a good ground for representation. Now, this is just a hurry session, right? But this is my thought process. This is exactly what I have taught you in my regular course, that you will get information. You have to go into the information and start picking up. Should I discuss? Should I review? Should I assess the reasonableness of the discount rate? Should I compare this with my knowledge of business? If there are a lot of estimates being used in, I will go for a representation letter. I can see the management working because they were doing the impairment workings, right? It was very clearly given that they do test impairment every year. So something like that. I hope you're getting a refresher on your CASP. I hope you're getting a thought process that this is exactly the way I taught you to make procedures. These are not actual procedures, these are thinking points. You need to add action, review, discuss, analyze before you can recalculate the impairment loss. You need to write the reasons to confirm. Every procedure should have to confirm, right? Every procedure should have a purpose, right? Okay, just let's move on to the next question quickly. We have the question number 2 as well of this exam paper. Let's see what was unusual in that. Uh, if you look at the question number 2 in front of your screen, this was just testing your ethical knowledge and your practice management knowledge, syllabus area B and C. Explain the ethical threats identified by the audit manager. And these ethical threats were given to you in the exhibit number 1. You just need to explain the threat. Evaluate the proposed safeguard. So the safeguards were given. You have to evaluate whether the safeguard given is good. You can agree to that. Or if you think the safeguard given is not good, recommend the alternative safeguard. So the safeguards were given. Either you agree with them and tell why you agree with them, why are they good? And if you disagree with them, then you have to tell the alternative. So evaluate the proposed safeguards, either agree with them, or if you don't agree, then you have to give a alternative. Now, if you agree with the proposed safeguard, you're not writing the alternative. You're still getting 1 mark into agree and justifying why you agree. If you disagree, you will give an alternative. Still, you get 1 mark. Safeguards have 1 mark. And for every threat you are explaining, you're getting 1 mark, just like you do in an ethical question. Now, if you look at the exhibit number 1, in the exhibit number 1, you have been given the ethical threats. Look at this. This is where the ethical threats were given. Threats identified is given over here. So you have to read those threats and identify the ethical issues. These are notes. Notes will guide you about your thinking process. And these are proposed safeguards. Either you agree with these proposed safeguards or you disagree, then you have to write the alternative. Now, just for example, if I tell you the first one, the way of going with it. Now, in the exam, how would you do this answer? It's just about you copy this question and you have 10 marks only, including the safeguards. So you take this to your word processor, and in the word processor, you will just start writing your answer. Right? It's right here. Part A, explain the threats. And in the second part, evaluate the proposed safeguards. Where you disagree, recommend the alternatives. Now, the first one. Okay, the first one is audit team has been in place for 7 years. Now, everyone knows what's the threat here. If the audit team is in place for 7 years, we have a couple of threats here. Number one, we have a familiarity threat because they will become too sympathetic with client. They will lose their skeptical mindset. They will lose their skeptical mindset. And because they're doing audit of this company for the last 7 years, they will even have a self-interest not losing this client. Because if you're working with a client for 7 years, it becomes your own client. You start owing that client. You start owning that client, sorry, and you start to believe that we should continue with it. So every team member will start getting a self-interest into it that no one would like to lose this client because you're there for last 7 years. So if you're working somewhere for last 7, 10 years, you would not like to lose the company or you would not like to lose the job. So that same goes with the audit team. So self-interest, not losing the client, because you know it, you know things have become very easier. Doing audit has become very quick because you've been there for 7 years, so you must be enjoying this audit. You know, you have a lot of knowledge of business, and you don't want this knowledge of business to go waste. So not losing the client will become your self-interest. You will explain, right, as like proper sentences. You know how you explain a threat, right? I'm just saving my time to wrap up the session quickly. You have exams tomorrow, but at least you can get 2 good marks here by explaining 2 issues. Audit team has been in place for 7 years. Let's see the safeguard. Notes. No other team within the firm who are experienced in this sector currently have availability to undertake an additional audit so that the team cannot be rotated. Now, that's the reason. They have been working for 7 years, but they cannot be rotated because currently no one is experienced in this particular sector. Now, in consideration of that, you cannot say team should be rotated because team can't be rotated because they have a limitation. They have a limiting factor. Proposed safeguard, engagement quality review to be performed. Okay, that looks very reasonable. Yes, every time you have a familiarity threat and you cannot rotate your team, I think engagement quality review becomes important. Number two, the audit engagement manager, Bora, is due for promotion this year. So a new manager will be in place. At least that's better. We get a fresh face in because Bora is due for promotion this year. So a new manager will come in place. No new manager has been identified to take over from Bora yet, but it is proposed that the existing audit supervisor should fill the role. So what's the sense? The existing audit supervisor who is working with this company for the last 7 years already have a familiarity threat. So you are just replacing the supervisor to become the manager in place of Bora, and Bora will take on a more senior position in the audit firm. So that's that's not like an ideal job. That's not like an ideal team rotation, but that's the best team rotation in the limiting factor. Look at the limiting factor here. Look at this limiting factor here. In context of this limiting factor, I think these are the best possible safeguards that you go with an engagement quality review, and definitely Bora has to be promoted to a new designation. So the supervisor will come up and take on the position of a manager. The familiarity threat will remain there, but again, you are just reducing a little bit of familiarity threat if there is a proper engagement quality review. And in the engagement quality review, you can check whether there are any evidence that you had been less skeptical or whether the evidence gathered was less or insufficient because of your familiarity threat. So I think the engagement quality reviewer has to play a very strong role here to check any symptoms of familiarity threat compromising the sufficient appropriate audit evidence. So I would agree with the safeguard in the context of the limitation given in the notes. We cannot say change the team, rotate the team, because that's not possible. So we have to choose within the limiting factor the best safeguard, which is on your screen. So you will appreciate it and you will write your comments on that. So in this question, the threats were given. See, the partner is in place for 7 years. Again, that's a significant familiarity threat. First, it was a team. Now it's a partner. Ideally, the partner should change after 7 years, but he has been in place for 7 years. So it's high time we rotate him. Otherwise, this is a significant familiarity threat because he's the leader, he's the decision maker. So he's the head, and everything has to depend upon him. He is the one to sign the report. So he needs to be the most independent, right? He needs to be the most independent, right? The plan for the audit engagement partner to be rotated with Joe Brown, the EQR partner, in year 8. Joe Brown has had only 4 years involvement with the client. However, Joe has given notice of their resignation from the firm effective 30th September 25. So Joe has already given a resignation effective 30th September. So can he is resigning from the firm. So ideally, that means he cannot become the new partner. So that means then the current partner has to continue. And we know these are like situations beyond control. Probably if you have no other experienced partner in this industry or sector in your audit firm, then you have to continue with the current partner for at least another 2 years, 7 plus 2, 9. And in those 2 years, you need to find an alternative because currently you found Joe as an alternative, but Joe is given the notice of he's already given the notice to resign, so he will not be available. So what will you do? You have to continue with the existing partner, though it's a significant familiarity threat, but you have to inform this to those charged with governance of the client. If the client has an audit committee, you have to inform them as well that we have to continue with the current partner for another 2 years. We'll try to find a replacement or a substitute over the next 2 years, and preferably after 9 years, he will be rotated. But we have to continue. So that's how you keep thinking about the threats. You keep thinking about the underlying self-interest, self-review, or familiarity coming out of each one of them. And you start building up at the safeguards. You look whether the safeguard is logical. Can we have an alternative safeguard? So on and so forth. Are you all clear? So this was a different track question, but though you had knowledge of this, I think this was more easier because the threats were given. You just need to explain is it self-interest? Is it self-review? Is it familiarity? Is it a significant one? What's the safeguard? Is it a good safeguard? Should I change the safeguard? So you have been given a structure and you just have to play within the structure for up to 10 marks, right? Okay. A little bit difficult part. Not difficult, but if you had some issues with that, that was a part here. Look at this part. Using the exhibit 2. Control C, 10 marks. Back to the word processor. Look at this part on your screen. Evaluate the professional and ethical matters. Now, you're very expert into that. Relating to fees, only relating to fees, and impact of the proposed listing, which should be considered by Pickle prior to accepting appointment as auditors. So you have to discuss the ethical and professional matters only relating to fees given in Exhibit 2 and what will be the impact of the proposed listing which the Suki Group is taking in the next 2 years in accepting the appointment as auditors of this company, right? So Suki Group is taking a listing in the next 2 years. That's given in the scenario. How will this impact your decision to become an auditor in the next 2 years? And considering the ethical and professional matters around fees. Let's see what was the story in the scenario. I hope that was pretty simple. Most students who submitted me the answers were able to pick it out. Just let's see what was the issue. Okay, can you see the Suki group in front of your screen now? Okay. Suki Group is an online retailer of luxury foods and drinks, which has undertaken a significant amount of expansion in recent year. Suki Group is currently not listed, right? But they intend to in the next 2 years. They intend to do so in the next 2 years. So if you become the auditor, how will the listing impact you? Suki Group is not currently an audit client of your firm, but Pickle Company do provide other assurance services in relation to corporate responsibility report and consulting service. So you're not the auditor as Pickle, but you are currently giving them other assurance services, other non-assurance services. Sorry, other engagement. Sorry. Suki Group is seeking a new auditor after their existing auditor determined they did not have sufficient international capacity. The finance director has asked Pickle to tender for the audit for the year ending 31st of October and has communicated that Pickle is likely to be the first choice. Definitely because you're offering them other services. You know a lot about client. So ideally for the management of Suki, you are the first contender to fill in the position of the new auditor. This is due to close working relationships they have already developed with the assurance department through the annual engagement to provide assurance on corporate social responsibility. Working close working relationships, definitely that means you have a little bit sympathetic and familiarity relationships, but we're not working on any other factor. We only need to work on fees. This is other than fees. But yes, if you think logically, this is more like a familiarity threat. And if you're offering them assurance services and you become the auditor, it also gives rise to self-review. But examining team is saying determine the ethical and professional issues in relation to fees. So is are these ethical issues relating to fees over here? No. These are journal ethical issues. If you get a journal question, yes, you have a self-review, you have a familiarity, but we're not writing anything from here till the time you get information about fees. You have been provided the following information from the billing department of your firm. Let's see what is the information from the billing department, how much is the fees, and what are ethical and professional issues in fees. Okay, summary of fees, Suki Group. Note, all invoices to date have been settled in full. Date billed, okay, this is a date billed, December 20x4, last year. They got corporate social responsibility assurance service, $80,000. They got valuation for purchase of brand, $140,000. So a total $220,000 was the fees in 20x4. In 20x5, they got $81,000 from corporate social responsibility report, and they got a fraud investigation, $157,000. So the total fees was 238 in the most latest year ending. Now you want to become the auditor for the year ending 31st of October 20x5. And the most latest fees we're getting from Suki Group as at the 31st of December is 238 already from the other services. Notes, if the firm decides to seek appointment as an auditor of Suki Group, the proposed audit fees is 358. So the proposed audit fees is 358 if you decide to take on this company. You are already getting 238, and on top of that, this is another offer coming to you, a very lucrative offer. Definitely, with every lucrative offer, you have a self-interest. So 358 is bringing with it a self-interest threat. Look at the total fees here. Total fees for Pickle for the year ended 31st of December are forecast to be in the region of 1.21 million. How much is the total fees of this audit firm? Sorry, the total income of this audit firm. The total income of the audit firm is 1.21 million. And how much will be the audit fees in that? 358. Now take out a percentage, 358 divided by 1.21 million. How significant is the audit fees? 29%, right? So the audit fees, which you expect to get from Suki as a proportion of your total revenue is total income as of a firm like is 29%, or almost like one student is saying 29.58%, right? So it's already touching that 30% mark. Currently, it's a non-listed company, and for the next 2 years, it will be non-listed. But later, it will become listed. We know that different conditions for listed and different conditions for non-listed, which you need to remember for exam paper. Now, just to give you an idea, 358 and 1.21 million. If you take it back to the word processor and you justify the first point, uh, the proposed audit fees, if I can just write quickly, because we need to get to one last thing before winding up the session. The proposed audit fees will be $358,000, and the total fee income of the audit firm is $1.21 million. This means the proposed audit fees is 29% of the total fee of pickle, which is which raise a significant dependency on client and a self-interest. There is no hard and fast definition of what what a significant dependency is, and the firm policies and procedures, the firm policies and procedures around quality management should define such limits. Now, the code of conduct is very flexible on that, right? That what makes an undue dependence? What makes an undue dependence? 30% looks like an undue dependence. Every student will say 30% is an undue dependence. But yes, the firm policies has to decide what makes an undue dependence as part of your quality management policies and procedures. But there is no such limit given in the codes. Second, currently, Suki is non-listed and will continue to be for next 2 years. Now, as per recommended practices of the code of conduct, if the income from a client is 30% or more, then the audit firm should get an external quality review in the fifth year audit review of the fifth year audit prior to issuing the audit report of sixth year. Now you are in 20x5, I guess, right? So in 20x5, it's 30. In 20x6, it's 30. In 20x7, it's 30. In 20x8, it's 30. In 20x9, it's 30. If it is 30 in 20x9, and in all these 5 years, it has been 30, then in the fifth year, you will need to get an external review of your audit work performed. And how much time you have to get this external review done before issuing the audit report of the sixth year. That's 20x10. So it's not like you get it done immediately when you're signing the audit report of the fifth year. You still have a year. Before you sign the audit report of the sixth year, you have to get this external review done. Now, we know these external reviews are done by mostly the regulators who are responsible for governing the chartered accountancy firms in your country. So mostly these regulators, like the chartered accountancy bodies like ICAEW, or in Pakistan we have ICAP. So bodies like such do these external quality reviews, but that is a condition for a non-listed company. But we know Suki will not be a listed company and will not be a non-listed company after 2 years. It will become a listed company. Then what will happen? In case of a listed company, in case of a listed company, the rule is 15%. If the income from a client exceeds 15% for 2 consecutive years. Now we know after 2 years they will become listed. So the moment they come listed, you will count your year one and year two. If the income from a client exceeds 15% for 2 consecutive years, the audit firm the audit firm should get an external quality review. The audit firm should get an external quality review in year two immediately. And if the same position continues for 5 years, now 15%, you're exceeding 15% for year one when Suki becomes listed. Year two, subject to external review. Year three, year four, year five, you're still more than 15%. So if in the same position continues for 5 years, you should resign as auditor. Now, these are conditions in both cases because currently Suki is not listed and they will be not listed for the next 2 years. So you're very safe. You're very safe, right? So I think you can still go with that 30% for the next 2 years because even you need external review in the fifth year. But the moment Suki becomes listed, your definition will change. Year number one, post listing. Year number one, post listing, are you above 15%? Year number two, post listing, are you above 15%? Yes. If you're still above 15%, then in the year two post listing, you will have an immediate external review before before or after signing the report. That's not an issue, right? But it has to be done in the second year. But if this position continues for 5 years straight, since Suki becomes listed, you have to refuse this client because that's not tolerable. Now, that's one position we are writing about, right? Think about logically. Go back. Please, I'm taking your questions quickly. Um, just go back to the Suki group. Look at this position. If you accumulate the audit fees with the fees of 20x5, look at this 238 plus 358. It will become more dangerous. Can anyone plus me the 238 and 358 and tell me the total fees? Because 238 is the fees you're getting from the non-audit services and 358 is the one you will be getting from the audit firm. What's that? 258 plus 358? That's 596. So you're adding the pressure. Okay. If audit fees proposed is added to the current fee income from non-audit services, it goes, it becomes $596,000, which is 49% of the firm total income and becomes more significant undue dependency on client. Now, one last perspective, just to teach you. Now, can you just see how much is the recurring fees here? How much is the recurring fees? Fraud investigation is not a recurring fees, right? That's a one-off investigation. Fraud investigation is not a recurring fees. Valuation of a purchase of a brand is not a recurring fees. But corporate social responsibility report, that's the recurring fees. It was in 20x4, it's in 20x5, right? So how much is the recurring fees? $81,000. Now, can you just plus $81,000 with 358? Recurring fees with 358. What's the recurring fees? 81, 81 plus 358. How much is that? 439. And percentage. The recurring non-audit service fees is around $81,000, is around 81,000, which if accumulated with the proposed audit fees is $439,000, which is 36%, still in the higher bracket. Now, you have some options. Either refuse non-audit services, either refuse non-audit services uh, and continue with external audit, at least to immediately reduce your dependency, uh, immediately refuse the $81,000. So either refuse the non-audit services and continue with the external audit. At least that will bring some positive impact to the dependency, right? And continue with the audit, or continue with both, and continue with uh, with engagement quality review each year to reduce threats and inform TCWG at Suki company. So one option is that you continue, inform this to the TCWG, have an engagement quality review every year just to keep things under check, and let the company become listed. The moment they become listed, 2 years down the road, you can then think about uh, refusing the non-audit services and just focus on the audit. But at that time, if you still believe only the audit fees is making more than 30%, you still have 5 years. And in that 5 years, if the situation doesn't improve, you have to resign as an auditor. So I think there is no hindrance in you becoming the auditor of Pickle, but you have to approach this engagement with a greater undue dependence. You have to keep a check through an engagement quality review right from the very start. And you have to keep a check after 2 years since the post company becoming listed. And 5 years down the road, if the situation is the same, you have to resign as an auditor. So this question was all about finding percentages, finding undue dependencies, telling that what you can, how long can you continue. I've given you a rule for unlisted companies for 5 years. I've given you a rule for listed companies for up to 2 years. Then you will get an external review done. And even after 5 years, the situation remains the same for listed companies. You have to resign. So I hope if you have even read the examiner answer, this was more or less the same. Some of the students really work well on these answers, which I've got, but I hope you're getting some knowledge. If a question like such strikes your upcoming exams tomorrow, you are having an adequate knowledge here, right? So this was a little bit different question, even though it's testing your knowledge about. I think every student find that dependency in this question, right? Every student found these percentages accumulating the fees because I've saw that in almost every student answer. You're working on those percentages. You're finding there is an undue dependency. But I hope you quote the rules of unlisted. You quote the rules of listed very well. And in the very first part, the threats were given. You just need to work on those threats, telling is it self-review, is it self-interest, is it familiarity? You need to look into the proposed safeguards, whether the proposed safeguards are good considering the limiting factors or any change required in the proposed safeguards. You have to recommend that. So I hope you will be able to do that. Right? Okay, just one last thing for 5 minutes. We're almost running out of time for this session, which I scheduled. So the Zoom meeting is for 1 hour and 30 minutes. So if it gets abruptly closed, please be careful about that. I just want to do this last thing from question number 3, only the first requirement. The second and third requirements, evidence and opinions. We have seen these questions plenty of time in past papers, commenting on the matters and explain the evidence and opinions on the audit report. But look at this first part, considering ISA 600 revise is important. Look at this first part here. Discuss the group auditor consideration when determining which component audit work, which component group audit work should be performed on. How you decide which component is important to the group or which component audit work you need to focus on. You need not to refer to any exhibit. Knowledge. How you decide this, that which component is important to the group. You know, the ISA 600 revise is not using the quantitative thresholds anymore. They're using the qualitative thresholds. Uh, a component, I'm giving you a skeleton answer. A component is significant to the group on the basis of one of the following. Please make it proper sentences. I'm just giving you bullets. Number one, uh, any recent addition of a component in a group structure, like any recent acquisition, any recent acquisition. So that particular component will become important, which has been recently added to the group structure. So you will take that as an important component. Uh, any significant control deficiencies identified in a component by the component auditor, that component will automatically become important for the group auditor. Number three, any unusual risk associated with the component, like the component is a foreign component, operates in a different country, operates in a different country from the rest of the group, or have a different currency, that will become important, or have a significant number of transactions with other group companies. Like, you know that a lot of group companies exchange between them. So if there's a significant numbers of intercompany transactions, significant numbers of transactions with other group companies, particularly the related party transactions, particularly the related party transactions. Again, that particular group will become important, or any recent changes in laws of the in the component country, affecting their financial statements, or the component uses different accounting standards than the rest of the group, different accounting standards than the rest of the group, or the group auditor assess the risk as high for component on the basis of the risk assessment at the planning stage, on the basis of risk assessment at planning stage. I've almost given you six, right? You need to write five. Explain any five of them for your 5 marks answer. So we know that under the revised ISA 600, we are not using any of that 15% threshold for a significant component. We are looking into the qualitative thresholds now, and these six are good examples of that. So anything which makes the component significant apart from the 15% threshold, just look for that in the scenario. But this was a knowledge question. So I hope this quick scan over the last 90 minutes or so must have been beneficial at this point in time when you have exams tomorrow. I hope you must have got some sense even of writing answers and going through questions, reading through them, extracting through them. No, you cannot add the 15% point anywhere, right? Yes, any component which is audited by another auditor itself is significant, right? That's the right answer, right? Is everyone clear with the session? I'm just winding it up because you have exams tomorrow. I wish you all the very best of luck. I wish you all success. Please ensure that you follow the time management. Wherever the time ends, wherever you are, stop and move on. Even you have done 70% of that question, stop and move on. That's the best way to maximize opportunities and your prospects of passing. If you just excel one question at the expense of other, that's an unwise strategy and will make you fail. Secondly, look at things you know. Don't get distracted with what you don't know. Leave that and come back to it later because you're doing the paper under time management, right? So there is a 10 marks requirement which you don't know, keep 20 minutes for it. There is another 10 marks requirement you don't know, keep another 20 minutes for it. Suppose you don't know 30% of the paper, keep 1 hour, come back to it later. Do the remaining 70% in the 2 hours you have. Look at opportunities. Wherever you find management bias, comment on that. Wherever you think management is doing a wrong accounting treatment, wherever there are estimates, wherever there are subjectivities, please comment on them because you're getting your professional skill marks around skepticism. Do calculations. Don't lose technical marks around materialities. Don't lose the communication marks you have around briefing notes because that can really be easy marks grabbing in the paper. Okay, I wish you all success, not going further than that because you have papers tomorrow. Relax yourself. And again, if you have any further clarifications needed, I might be active over the WhatsApp group for the next 2 hours, responding to your questions. I might be doing a quick motivation session and posting. I'll not be taking that live, but I'll just do a quick 15-20 minutes motivation session and posting it for all of you. So you can enjoy that as the last thing before you go to sleep and wake up tomorrow fresh, go and give your paper. I wish you all the best of luck, and I hope you productively like my overall course and the techniques which has been taught to you, and you would go and do the best. I want good scores from all of you. I've seen some amazing assignments, and I mentioned in some of the assignments that you should aim for 70 plus, but all of you should aim for good marks. All the best. Your tutor, Kashif Kamran, signing off from this quick scan of March June 24 paper. Have a nice day, and I I believe you will keep yourself calm tomorrow. Goodbye and Allah Hafiz. Yes, I'll be sharing the files, right? And the recording as quickly as possible.